Let's cut through the crypto noise. How can you have a crypto-friendly practice without all the chaos? How can you build grounded strategies to integrate digital assets into your practice while staying true to fiduciary standards? Today's podcast guest will tell you exactly how to do that.
You're listening to the Resilient Advisor podcast. This episode of the Resilient Advisor is brought to you by the Titleist Advisor Network, where independent financial advisors become resilient, high-growth business owners. Since 2003, we've been private equity-free, helping advisors build real equity in their firms. Learn more at jointitleist.com.
Welcome to the Resilient Advisor podcast, where we bring industry experts to help you build your business your way. My guest today is Tyrone Ross, the founder of Turnqey Labs and 401 Financial. If you're catching this live on LinkedIn, YouTube, or X, and you'd like to ask Tyrone a question, simply type it in the comments and I'll make sure we pose it to Tyrone. In this episode, you're going to walk away with some practical insights on how you can put digital assets in your practice today. Tyrone, welcome back to the podcast.
I'm excited to be here, my friend. Always good to see your face, and these are always fun. So let's dive in. Let's do it.
Well, Tyrone, Theodore Roosevelt once said that credit belongs to the man who is actually in the arena, and you've certainly been in the arena for a long time, promoting and advocating for education around crypto assets in wealth management. So I like to tell listeners, we've been doing this a long time. Yeah. I actually met you when Bitcoin was below $10,000, and I wanted to learn more about crypto, and you came on for an educational series. That's how long we've been doing this. Yeah. So let's start with some basic questions, and that folks that maybe even are still a little bit new to crypto might want to really lean into. So why should a financial advisor today in 2025 care about crypto at all? And I know it seems crazy to still ask that question.
No, it's not actually. It's amazing as I still sit here. A couple of weeks ago, I had a presentation to the San Diego Financial Planning Association, and there's still a lot of advisors that are clueless on this stuff. So I think the main thing is, this is the first time in my career where I felt like it was a lack of my fiduciary responsibility not to have a conversation with clients about it at all. The environment has changed mainly because the regulatory environment is clear. This administration is all in on all things crypto, and forget everything else. If you are a financial advisor, and we obviously pay attention to what our government does for various reasons, you need to be paying attention to this. You need to be having conversations with clients about it. Mainly because before it was just you had to worry about them maybe having a Coinbase account. Again, by the way, for those keeping score at home, there's 110 million accounts at Coinbase. Your client has one there. I think this is the first time in my career in crypto, 12 plus years, where clients could get exposure multiple ways, directly or indirectly. DATs, ETFs, SMAs, you name it. That enough to me is in and of itself a reason for advisors to at least be conversant.
So for the advisor that hasn't started going down this path, they've ignored it. And Tyrone, they're still out there because they reach out to me. How should they start the process of getting up to speed to learn more about it and how they could use it inside of their practice?
You know what? It's funny. I'm going to turn this on its ear now. First of all, there's a book that I recommend to every financial advisor. It's The Intelligent Investor of Our Space. I know, heresy to say that, but it's called Crypto Assets by Chris Berninsky and Jack Tater. It's a must. You got to pick up that book. You have to read it. Put it on your bookshelf right next to The Intelligent Investor. But here's where I think it's different. What clients are realizing is their financial advisors know nothing about this stuff. And I think the best way now for advisors is to, one, poll your clients, see who owns it and who doesn't. Just ask. Have a conversation with them about it. I feel as though that would be a good venue to get started. Now you got to do it with the right client, because with the wrong client, they're going to go, well, idiot, why don't you know about this more than I do? But I think there's particular clients that advisors can have conversations with. You know, your practice better than anyone else. And that's a good place to learn. The book, of course, and then the last thing is, I've been saying this for years. Crypto is one of those things you have to experience, right? So send the family out to the grocery store, lock the doors, go into a room, lock that door, and try to open an account at Coinbase, right? Like, so no one will know, or Robinhood, or Cash App, or whatever the case may be, and experience how easy it is. Whether you think that's good or bad is a whole nother story. And I think those are the three key ways that you can start to get at least familiar with what's going on here, the good and the bad, and start to save your clients from a lot of the nefarious things that are going out there, the scamming, the pig butchering, all that other stuff.
So 5 years ago, when we first started doing podcasts together, you would say over and over again, educate before you allocate. And that's still true today. There's even more to understand now because of the different products out there. We have our first question from Jeffrey Jansen. He is curious about your take on the recent spate of Bitcoin treasury companies. Is it a boondoggle or crazy buying opportunity?
Jeff is my man. I love Jeff. What's up, man? It's a boondoggle. I think it's a little bit of both. You gotta, like everything else, you gotta look at the right ones, right? So real life situation here, right? We have a client of ours that owns a ton of strategy, which again is the OG of these things. But I think recently what you're seeing is a lot of these just pop up, and it's dangerous because folks are just going to pile in. They're not doing their research. You take a company that was making lemonade and you mix it with a company that was doing blenders, and then they come together and then they're buying a bunch of Bitcoin. You got to be careful here. So I think it's more boondoggle. I think those that own strategy have owned it and have seen what has happened there. Very few people understand the financial wizardry that he's doing. So I think you got to be really careful with the debts.
Yeah, excellent. Thank you for the question, Jeff. Tyrone, about 4 months ago, my 78-year-old father, who's very, very conservative when it comes to investing, said, Jay, should I be looking at Bitcoin? And I would have thought 5 years ago, my first reaction would be, well, there's a top. There's a concern when my 78-year-old father is asking these questions. So the question is, clients are curious, but they're also skeptical. The two biggest objections are typically the volatility and potentially a negative or bad reputation for people who haven't really done the research. How do you recommend advisors turn those objections and concerns into constructive conversations so they don't sound like a crypto promoter?
So when I started on Wall Street a long time ago, I started in a boiler room broker dealer where you're pitching stock all day, and you would have a rebuttal book, right? And the purpose of the rebuttal, right? Let me ask my wife, and you go to the let me ask my wife section, and you got all the rebuttals, right? I'm showing my age here, but but the reason you addressed that rebuttal was to distract the farmer on a tractor somewhere in Iowa when you're in Manhattan away from what it was that you were trying to get them to do, was to buy 1,000 shares of Berkshire, whatever. But in this case, I think addressing the rebuttal is important because that is the way you get people to understand. Because I was the same way. So I was like, there's some mythical man named Satoshi that created 21 million of things. Yeah, okay, right? So the volatility data, right? I think you show that if you have clients, you can now, I think there's enough tools and data, which we'll get into, to show clients what this looks like over time. Volatility is kind of the price you pay with this for the outsized returns that you get over a 1, 3, 5, 10-year time frame. And then the other thing, as far as like the scams, it's been hacked, all that other stuff, I think the best thing that you can do is, again, more data. But in that situation, you want to give people research, credible research for them to read. And it's not going to be something where you just send somebody something and it didn't work on me and I'm the biggest crypto hippie you're going to meet. It takes some time, right? So I think the first thing is to have a conversation with the client, give them materials, let them ask questions, right? Give them more materials, let them ask questions. It shouldn't just be, okay, the wholesaler walks in, buys the office lunch. They give you a fact sheet. You put it in front of the client saying, we're buying this, add to your portfolio. It doesn't work that way. I think it should be really, really long of asking questions until the client understands it, gives them reasons why, model, back test, do all of these things. But the rebuttals, I think, are positive and constructive because, one, you get to show value, and two, if they don't hear it from you, they're going to hear it from somebody else. And more than likely, whoever else they're hearing it from is not qualified to give them advice.
That's right. Rebuttal books and fact sheets. Man, we are dating ourselves, and I'm much older than you. I remember mine was a photo album, so I could flip to the rebuttal really, really quickly. I think I've saved it. I should pull that up. That could be a podcast in itself.
Absolutely, man.
No idea.
Absolutely. I tell Josh Brown all the time, me and him gonna have to have like a cold call off for charity to see who could get more closes.
All right, so a few more of the more basic questions that you take all the time. So for my audience, when products from the spot Bitcoin ETFs that have come out to covered call strategies to tokenized treasury products and companies, the menu of options is really starting to explode.
Yeah.
What framework should advisors use to evaluate whether it's a legitimate portfolio fit versus something that's just marketing hype, for lack of a better term?
One, I think it starts with you. You have to know your knowledge base and your savviness on the space. How deep can you go with the options for clients? By the way, if you can't go that deep, you should be careful, because if a regulator came in and looked at all of these things, are you necessarily aware of all the fees and the options? Was this in the best interest for a client? Sometimes it's not, guys. Sorry. So you should know the breadth of options, right? So that's the first thing. And you should know your ability to communicate that to a client, right? At 401, we're big believers in on-chain. We don't use custodians of any sort, traditional or crypto, but we feel like we are strong enough and educated enough to be able to defend that position, why it's best for us and our clients.
Tyrone, let me stop you there. What do you mean by that?
So we believe that the future of asset management and wealth management is on-chain, meaning that it's a bearer asset, that you're going to hold the assets directly in a wallet, right?
Okay.
So we get nervous when clients tell us that they have an account at Coinbase or any of these places, and we go, that's a red flag to us. Wait a minute. Let's work on why, how, where. Again, does the client know better? Get those assets off. Coinbase is a honeypot, right? 8 of the 11 ETFs reside there. This goes back to the regulation of when the banks weren't able to actually compete to be custodians. So a lot of that went to Coinbase and a few others. Fidelity has theirs, and so on and so forth. On the traditional side, do I really need to talk about why custodians are a pain in the butt, right? We removed that. We are an advice-only firm. We don't custody or trade for our clients. Custodians create a really big barrier of frustration between the client and the advisor. I think any advisor being honest will tell you that, except for those that are probably part of the referral programs for Fidelity and Schwab, but I digress. So we remove that. We are advice only, and we think that even on a traditional side, and again, if you don't want to believe me, you can look at why Fidelity, Schwab, Virtu, Citadel, and others are an investor in an on-chain exchange called EDX. This is where the space is going. We want to be there first. So we think that is a better option. It's not for everybody right now. It's still very early. But we don't believe in a custodial relationship with our clients. We just think it creates too much frustration. It's expensive, and we can reduce fees. We can add security, and we can give them a better experience by removing those things.
So you're not custodying any of your clients' assets. You're just giving advice on like a subscription basis?
Yep. Hourly subscription and flat fee for planning.
So Tyrone, I've been getting DM'd by folks that are trying to build these on-chain custodial platforms, and I think that's an oxymoron. I think I just butchered that. But what their pitch to me is, Jay, everything's going to be tokenized. Let me show you what our product can do. And I just ignore most of them. Well, What is that? What do we need to be paying attention to?
So let's start with tokenization. I am so bothered by this. Again, I'm the biggest crypto hippie you ever meet. You know this. The tokenization thing to me is out of hand. It's the great marketing term right now. You throw it in the pitch deck, you put it, oh, yes, right? I'm still trying to figure out what a real world asset is. Like, what does that mean? Crypto has a marketing problem, right? Do I think things will be tokenized? Great. I prefer to say assets on chain, right? Like, I don't need a tokenized version of an ETF. To me, that's silly. It's putting, training wheels on a Ferrari and then bubble wrapping the Ferrari. It doesn't make any sense, right? So what that means is, and again, on chain, for those keeping score at home, is just simply meaning on the blockchain, the asset is native to that chain. It's no wrapper. There's nothing around it. You literally buy it off of that chain, Bitcoin, Ethereum, or whatever, and you hold it in your wallet that you control, right? That's all that means, right? An exchange wallet, right? Or an exchange account at a Coinbase, a Robinhood, a Gemini, an Anchorage, a Kraken, a BitGo, right? Fidelity, or Schwab. Those obviously have a lot more barriers to moving your money, having to call in 6 weeks for 401k rollover, things like that, right? Those are the type of things that you removed if assets are on chain. Now we'll get to tokenization. I do think that is going to happen, but you're going to have a lot of people play ball here, and a lot of them aren't going to play ball. Right. So it's happening now for sure. Right. You got Buildle, which BlackRock has, Franklin Templeton has theirs, Benji. You got a few other things, but that's just the little kids' table exchanging, their little Pokemon cards, exchanging lunch. Right. I'll give you my Cheetos. You give me the ham sandwich you got. Right. If this is to grow, we need the big players to play ball. Right. The custodians are going to have to play ball. Schwab is still trying to figure out if they're going to do spot Bitcoin trading. Right. Mm-hmm. Yep. I don't think we could expect them to get up to be, to do tokenization of assets that quickly. Now, it will become a thing, but I think we're really early on this. And I get it. The hype train has to start in order for it to happen. But it's that really, really precocious 15-year-old in high school that everyone says is going to be a Hall of Famer. Let's let the kid play varsity first, and then we'll figure out what happens after that.
Yeah, let puberty fully take hold. Make sure it grows. Yeah,
some of these kids do go backwards.
So, if we're having a conversation 3-5 years from now, is there a world where instead of having an account at Charles Schwab, somebody instead has a wallet on their phone, and in that wallet they hold their NVIDIA, they hold their tokenized gold, they hold their Bitcoin, as opposed to having a relationship with a Charles Schwab or a Fidelity?
Man, I'm starting to have an effect on you. It's working. That's exactly what it's going to be. And this is what I've been trying to tell everyone to listen. I still get tomatoes thrown at me and people turn their face up. But here's what it's going to be, right? Jay's going to have a public address, right? Wallet address for exactly what you said. It's going to hold all of those things. If you put that address in at Fidelity, it's going to show all of your assets at Fidelity, cost basis, reporting, all of that. Put that same address in at Schwab. Schwab is going to know the differences. Oh, this is what he holds at Schwab. We have all of his retirement assets. If you put that in Vanguard, oh, this is just his 401k. That's where we're going, because the key to any tokenized or on-chain or whatever is at some point those things have to be native to a blockchain. So whatever chain that is on, and you see a lot of them using Ethereum for that. And folks are announcing that they're, every company is announcing their own stable coin and blockchain now. You got a lot of these things happening. Why? Because those at some point that is going to be the rails, right? Swift yesterday saying that they're going to, put some things on chain, and obviously Ethereum being a part of that, consensus and the whole deal. So yes, that is where we're going. Probably longer than 5 years, right? You'll start to see some pieces of it happen along the way, but that's essentially where it's going to be. It's going to be a better experience for clients. It's going to be a better experience for advisors. It'll be a better experience for the entire space, and it's going to stink for all the middlemen in between that.
Patrick, I'll get to your question in a second. I just got to ask a follow-up on that. So how does that work? 10 years from now, somebody in their 70s is going to be walking around a nursing home with a phone in their wallet. And when they have to pay for stuff, they're going to just leverage that wallet to go and take care of things.
Yes, but here's why that's going to work. Let's back up. There's going to be a couple silos here. That 70-year-old has assets with 401 or whoever, right? They have a financial advisor. They have fiduciaries in their life. Why regulatory clarity is so important is this. In a case like that, someone is 75, they're in a nursing home or whatever. There should be fiduciaries that are part of a key or social recovery group for that individual, meaning 401 Financial has a portion of the key to that wallet. The estate planning attorney has a portion of the key for that wallet. And then whoever is the caretaker for that individual has as well. That's a 3 of 5, right? What they call multi-signature setup. In order for funds to move, all 3 people have to sign before that $100,000 is moved to fund their grandkids' education. That's a much better process than it is right now with the way seniors are stolen from, right? And then that's also going to be great, right, for estate planning, right? Smart contracts, things like that. Bear with me for this for a minute. So it's not just going to be as simple as going and using a wallet for that age group. That cohort should have that social recovery, that key structure for that wallet set up. So if they were saying, I still don't understand this stuff, I know it's easier, whatever, you go to Publix and do the grocery shopping for me, right? Here's my wallet or whatever. Then you're going to have a second group that is going to be comfortable with, okay, an account is essentially a wallet now, right? That's just what it is. We all have it on our phone when you download your airplane ticket and it's on your phone and you got, right, your Apple Wallet. It's the same thing. That's going to go, okay, right? And those folks now, to me, are somewhere between 35 and 55. They kind of grew up with this stuff. It's just, okay, I get it, right? QR codes, all these things. Where now if I want to move money or I want to scan something or whatever, it's very easy for me to do that. Now, what's going to happen as well, right, with the higher part of this, there'll be multiple wallets. If I'm using a wallet to grocery shop, it's not the same wallet that I want to hold my assets or do transactions. That's silly. So right now, folks that are crypto native have multiple wallets. You have wallets to sign, you have wallets to buy, you have wallets to swap, you have wallets to bridge. That's why there's multiple wallets, and taxes are a mess because people have all of these things that needs to be consolidated. So this group will be right on the fringe of that. They'll get it. They'll understand it. They'll probably have one wallet, public key for these things that they do. The last group are the group that I just described. They're going to have multiple wallets at multiple venues that are native to particular chains to do certain things that they're just using. Like my partner right now, Eric, he's probably watching this. We talk about it all the time. He's using EtherFi, right? Forget what that is right now, but he's literally just spending on that card. It's crypto. It's all crypto. You fund it and you spend money on it, right? It's that simple, right? And he's slowly removing himself from the fiat system. So, but he really is, again, CFP, by the way, but really understands the space. We both have multiple wallets for different things. And it's just easier for us to navigate that way. Now, roll all of that up into what you're saying, where everyone just has a wallet, just wallet infrastructure. And you're seeing that already. They're going to say, okay, Jay, this is your existing accounts. You have your taxable, your non-taxable, all these different things. We're just going to put some infrastructure over that. That's going to essentially be a wallet that holds all of those things. And then as needed, you'll use that wallet to be able to make transfers easier, to rename assets, whatever. So I think that's where we're going. It is going to be a slower process, but in the example that you said, I think we would be able to remove them folks from having to go from a payphone to an iPhone where you need to FaceTime. And my mother is like, I'm like, Mommy, I'm FaceTiming you. The wall is not necessarily who I want to talk to right now.
Most of us our age can relate to that. From a payphone to a face phone. All right. So if you're an advisor today and you plan on selling your business and retiring in the next 5 years, Tyrone, this just doesn't seem like something that you're going to invest time learning. Yep. If you plan on being an advisor a decade from now, this appears to be something that you really need to ramp up on and start to understand the importance of it. Where do they get started? How do they get started?
I think I would look at my stack, right? My existing tech stack and providers. I would do an audit of who is at least helping me with webinars and some early data feeds to understand this stuff. It shouldn't take you long. It's not that many. I think the second thing is, again, back to what I said, poll your clients. Who owns it? Are you getting questions? Look at your existing book of business. The age, right? Are they similar in age to you? Are you getting more and more younger clients? I think just do an examination again of your firm, of your practice, of your book of business, and then figure out a strategy there. But it has to start with looking at the tools that you have available, and are you even ready to do this, right? And this is interesting now, quick, and you would probably understand this, is that a lot of breakaway advisors are looking to go to firms that are kind of being tech forward here and looking at, all right, is there any type of crypto offering, right? Once that happens, I had an advisor come up to me at Future Proof, very frustrated because they can't buy the ETF after the client signs a stack of paper thick enough to choke a horse, right? You put it in the model, but you can't rebalance the model because you can't get paid on that ETF. So it creates a whole thing. It's non-discretionary, blah, 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 right? So you got to figure out the mechanics of this because that could be a very frustrating situation for the clients. Second thing, after you do that, your existing stack, you poll your clients, you see who owns it. I would then, whether it's myself or others in the industry, find advisors that have been doing this for a long time. Converse with them, keep them in your centers of influence, back to the Merrill training program, your COIs. These folks are very important, right? Ask questions. Eric and I talk to advisors all the time. We have no desire to take your clients, and we don't want the assets. Call us, ask us questions. We'll sit in the meeting with you. We make you the hero, right? And it's very easy to do that because we have a way of helping. That is essentially, we're just an extension. We're an outsourced crypto CIO, if you will, for your firm. But get around these advisors that are doing it, that can help you with, okay, well, this is the best tech for this. This is books for that. This is the best, client management tool, whatever it is, and start to develop that network of folks that we have for estate planning, that we have for taxes, that we have for all these different things, annuities, life insurance. Crypto should be the same thing. You're never going to get up to speed. You're just not, right? And you're definitely not going to catch up with the firm like ours, where I think it's inarguable at this point that we are the tip of the spear when it comes to crypto and wealth management. So that's the second. And then the last, I think, is you have to change the environment with which you start to absorb this. And what I mean by that is simply, you might have to have CNBC, Bloomberg, Barron's, and CoinDesk, right? Like you just got to add CoinDesk to it, right? And you got to be comfortable with the headline article being new layer 2 solution drops. And you're like, what is a layer 2? I have no idea, right? So I just think you got to open yourself up to that. And there are some things that I'm doing personally to help advisors that I've been doing for 12 plus years now with education, which we'll get into. But I think those are the prudent ways to handle the practice management side of things.
All right. Excellent. I scripted all these questions for the interview. I forgot. I don't need a list of questions. You and I can just have a conversation. We've only got about 15 more minutes. I want to bring in a question from Patrick Sittner. When it comes to portfolio construction, what's the best way to build out a broad digital asset model? Likely Bitcoin as a foundation, maybe some Ether, blockchain. What else? Help them thinking through that, Tyrone.
So there's a couple of ways to think about that. I think one, again, going back to your tools, I think if you have tools right now to simply model and build a model portfolio of what that'll look like, again, hard to do because not too many folks allow you to do that. I think that's the best way. Just kind of see if you can spec one out. I think you could probably do that now on DeepSeek, right, or Claude or something like that now, just put a mock model together. See what that would look like. But I think obviously Bitcoin is the bedrock, right? Maybe there's some Ethereum there, maybe there's Solana in there. But again, I think what is the goal of what you're trying to do? If I could talk my book here for a minute, this is why we created our model at 4-1, right? The ticker is INDX. It's broad exposure, right? To a model that we created, right? So ideally, I would just tell Patrick, buy our model, right? But it's not available yet. But I think what he could do is similar to what, and we're taking the wisdom tree approach, right? You can't actually go to wisdom tree and build a model, but they're going to give you, hey, here's the framework of why this, like the methodology, what this model is, how often it rebalances or whatever. So similar to what I was saying before, I would guide Patrick to a Bitwise. Again, taking a look at our model, looking at, there's a Bloomberg Galaxy Index, like see what's out there. Most of them do have a lot of junk in them, right? And then whittle it down to what you think makes sense for you. Ours is backed by our own methodology, our own scoring system, fundamentals and risk scores, and we put our model together. So I think that's a good way to look at it. But generally, I tell advisors, stick with Bitcoin. What does it look like to add Bitcoin to a 60-40? Where does it come from? Right now, probably bonds. Sorry, Bogle folks. But I think that's a really good way to start. And then you can start to nibble on the edges with some altcoins.
Excellent. Patrick, thank you for the question. Tyrone, the first thing advisors think about if they're new to crypto is compliance.
Yes.
Risk, custody, due diligence, real pain points for advisors that almost create inertia. What practical steps could advisors take today to explore it for their firms safely without putting themselves at risk? First thing is, which is very important for everyone out there, please, if you're going to do it, add it to your ADV. Sit with your compliance officer or your counsel and add it to your ADV. That's the first thing. What exactly are you going to be doing? Who is the custodian? What exactly are the services that you're going to provide? What are you going to charge for those services? How often are you going to recommend it? How often are you going to do security? All these things are really, really important. Obviously, most of that goes in the ADV, but in the event of an audit or whatever that may be, and again, just firm practices, you want to have all these different focuses, mainly around security, how often you're meeting with the client. We meet with our clients monthly, just generally, whether it's traditional assets or not, but touch points as well. I think most advisors, if you're going to be doing crypto, should be speaking with your clients more about it because it is volatile and there's a lot that happens. It's 24/7, 365. There's a lot that happens. So you should be meeting with them monthly. Put it in your ADV. That's where it starts. After that, I think now you need to figure out exactly what is the easiest way for you to do this without one, getting sued or fired. I think the easiest way right now for advisors is the ETF. I will not deny that. Everyone knows I'm not a fan of the ETF, but that's a show for another day. But I do think the ETF right now is the easy button for advisors in some ways. It doesn't solve all the problems, but it solves some to get clients access, sit it right next to their Apple and their NVIDIA and kind of be done with it, right? Again, you're capped on what you can expose them to and so on and so forth. Now, again, knowing your clients and what this looks like, document all client conversations, right? This is exactly why at Turnqey, we have an integration with Wealthbox, so you can kind of see what the client is doing, putting this information in there. CRM is going to be your source of truth and help you keep your job as far as crypto is concerned. Stuff as much into the CRM as you can. And lastly, if you're going to be trading or not, if you're trading, you got to look into E&O insurance, going to be very expensive. I can tell you that right now. There's very few providers there, but you got to look into E&O. If you're not, you're advice only like us.
You're relieved of that burden. But again, I think you still have the expectation of documenting conversations, making sure you're doing things that's in the best interest of the client, not yourself, being aware of what's going on in terms of fees, security, and things like that. By the way, one example I want to use that our legal brought to me that I think is critical now with everything that's happened. Right? By the way, advisors, please don't help your clients open Coinbase accounts. Please stop doing it. But now, my firm has a pretty large, not my, literally speaking, but an example. Your firm, my firm, has a really big position in Coinbase. Okay. And then I find out that I'm using certain tools that my clients have assets at Coinbase as well. So we hold it, they hold it, and you start to discover that they're trading there, they have a Coinbase wallet, an exchange account, or whatever. That creates an enigma for a financial advisor, right? As you know, it's really important to understand now the way it was described to us is that if you're recommending Coinbase for whatever that may be, right? Oh yeah, it's a great place to hold your asset, go there, do this, that, and the third. You're recommending certain changes or whatever to a client's held away Coinbase account. You hold it internally. The firm is trading it internally. That can be looked at as an outside business activity or something that needs to be disclosed, right? You can't necessarily sell away, but these are all things that firms need to be thinking about. And that didn't even cross my mind until our legal mentioned it. Now I was like, holy. So, and he's one of the best in our industry, ex-FINRA, really good friends with Gary Gensler, has done a lot at some of the bigger firms in the industry. And when he pointed that out to us, it was kind of like the whoa, right? So I think there's a lot of nuance here because crypto was basically birthed away from firms. And now the clients hold it before the advisor could get to it. One small caveat to that, because I wanted to test that and see. I won't mention the firm, but I will say you can't name two firms in our industry that are bigger than this particular firm. I was blessed enough, because I know the CEO of this firm, to have a conversation with the chief compliance officer at this gargantuan, massive firm. And we were simply talking about the ability to use Turnqey. And he said, we love the idea. I think it's great for advisors to know that. But when that account is linked and now the advisor can see it and give advice on it, we have to be confident that the advisor is smart enough, right? And can give prudent advice on that. But also, again, what is happening internally here at the firm, holdings and all these other things. So I was like, oh, okay, this is actually a real thing. So the aggregation of the held away assets versus what could possibly be now happening inside of the firm is something that we'll need to be aware of. So from there, I was like, okay, we could take the compliance angle where it's like everything the client has. And then if there are advisors that are trading crypto or hold crypto or personally and or building positions in stock portfolios or whatever, we should track that as well, because if you're not, you're putting yourself at risk.
Let's use that as a pivot to talk about Turnqey. Could you tell us a little bit about the firm, what the value prop is for advisors, and who should be paying attention?
Yeah, so Turnqey, think of Turnqey as your by all accounts Plaid Yodlee of crypto. We start as Plaid and then we end up like InvestNet. So basically, we allow you to send an invite to the client to link anything in the crypto ecosystem. It could be a Coinbase exchange account, it could be a Coinbase wallet, Gemini, Robinhood, you name it. We allow them to OAuth in like they would, like a Pantera does or anything to show you that data. But once we get that data, we turn into the InvestNet, Adapar, Black Diamond, where we do all the performance reporting, right? So we do all of that, similar to like a custodian would with that custodial feed of what's happening there. And then via APIs, we send that data back into the workflow that the advisor uses. So that's the goal, right? I know financial advisors don't want to pay $2 million for a condo, go across the street to use the bathroom. You heard me say this all the time. If it's not in your workflow, it doesn't exist to you. So the goal was to build the tentacles into the workflows that advisors use. So we're available in Wealthbox now. We have an integration with By All Accounts. We're working on a big one now that I can't say, that I'm really excited about. That's going to give us even more scale to thousands and thousands more of advisors, which is critical. So the goal for Turnqey is to integrate up and down the advisor stack. So we want to be in the CRM, we want to be in the portfolio management software, we want to be in the planning tool. So that's our plan. But so we're just piping the data there, and you have it. You can manipulate it as you see fit. So that's kind of where we started. We're 3 years in now. We've just brought on an incredible group of investors to kind of, help us scale, which our next phase, which is going to be one, we're going to turn on trading inside of the platform at some point to allow advisors to trade compliantly. There's ways that we're going to do that, our secret sauce. But also we are launching a platform called Tape next month. We're on track to launch next month. It's called Turnqey Asset Intelligence Platform. So again, think of it, mainly we're like an airport, right? We're basically, you come, you take an action and you get out. We don't want you to live here, but we're promising you, hey, Jay, come here, run an analysis, right? Do some back testing, link accounts, but we're going to make sure we get that data back to you, Amazon Prime style, to your workflow. Don't live here. You should take a couple actions and get out, similar to an airport. Here's your gate. Here's your destination. Here's your seat. Bye. We'll see you next time. So we're launching that. The goal will be any portfolio that is linked in our platform gets a Q score. So we're going to give it which is our proprietary score that we built for risk. So you'll get an idea of how risky this portfolio is not, which is really cool. And then we're also going to give the advisor the ability to ask me questions inside of the platform. You'll have access to the 401 model, which is essentially be the benchmark in the platform. So it's going to be a beautiful experience for advisors to get the ability to navigate the space. We're going to do the tax reporting, 1099 generation, all of that. Remove the crypto leads, give advisors everything they need, nothing they don't. Sync your CRM, and we're going to get that data back to you. We can CSV, however you want it, we can get it back to you. And then we're going to make good on what the promise was for OnRamp 4 years ago.
I got to tell you, you and your partner, Eric, are uniquely situated to be able to deliver on that type of product, given your industry experience and digital asset experience. To learn more about the product, visit Turnqey, that's TURNQEY.xyz. Tyrone, before we wrap up, I want to pull up your X account.
Do it.
All right. And what I'd like to do, in almost rapid fire, I'd love for you to explain some of your posts for us novices in the space. But first, you were on CNBC. You gave an interview talking about the future of wealth management, and all of FinServ is on chain. What does that mean to somebody who isn't deep in the space?
It simply means that, as I was explaining before, all assets are just going to be held, stored, transacted on new rails, right? We're just redoing the existing rails, and being on chain just simply means having the ability, right, a bearer asset to control that asset, move it anywhere, anytime, with less barriers and less friction.
Excellent.
So, but those that are all excited for tokenization, you're excited for an on-chain future. Congratulations.
Next post, your response to Jake, and I'm not going to try to pronounce his last name. TradFi didn't suddenly decide it loves crypto. TradFi doesn't think centralization is bad after all. TradFi isn't trying to buy your bags. TradFi is doing what it always does, exploiting its incumbency to expand its control over the financial system. TradFi is the competition. What does that mean, Tyrone?
It means this is exactly why I wasn't a fan of ETFs. But basically what it's saying is there's been, traditional firms are permeating crypto now. They watched it for a while and they're realizing it's inevitable. So they're coming in, they're buying, they're acquiring, they're manipulating the price. They're, making acquisitions that are critical to them getting human capital, the knowledge to be able to do this. And basically, I think what Jake is saying, hey guys, they lulled you to sleep, right? Like BlackRock has come in and literally taken over the space. Fidelity has come in. Franklin Templeton has come in. all the, and Schwab, and I keep telling people, when Schwab gets here, night, it's going to put out a lot of lights. So I think that's what he's saying. And I couldn't agree more, because everyone just wanted their bags to go up. But those of us that got into the space was basically saying, hey, those guys are the competition, right? So now we're sleeping with the enemy.
Next post. So in response to Erman, who said, one of our founders shared a new insight with me. Their TVL jumped 75% after being listed on the Base app. That's why we are recommending all of our Base founder to make Base app a core part of their go-to market going forward. And you responded to that saying exactly why you and Eric built the 401 financial model, INDX on Base. What is Base?
Base is Coinbase's on-chain, or their blockchain, right? So it's basically where all their on-chain assets are held. So Base is a blockchain that was launched by Coinbase, and every Robinhood is going to do theirs. Kraken is going to do theirs. Everyone's going to have their own blockchain. But this is a blockchain that was created by Coinbase in order for folks to build on-chain. And our model that we built on-chain is built on the Coinbase blockchain. Give you an example of why that's really cool. You can take, I believe, and Eric would know the exact, I believe he told me it was a penny, right? We basically took a penny, and that was going to cover all of the gas fees, basically the transaction fees, for us to build our model. That's absurd, right? And it's a couple clicks, you own it, right? Right in your pocket. So that's why we're excited about that. The TVL, the amount of creators and everyone building on Base is really awesome. And it's a phenomenal experience. So basically all of the assets that we hold are native to the Base blockchain. Very easy to own, create liquidity, obviously. And then, you know, the model that we built, you could essentially get access to all of those in a couple clicks. So it's like a token almost. But you own each of them individually. That's the power of doing it on chain. True direct indexing, not whatever's happening right now on traditional rails.
Well, I tell you, we've passed our time. I do want to bring up one more X post. I tell you, I started the podcast talking about the man in the arena because as I was prepping for this, I realized, man, you have been public with everything for so long on X, on LinkedIn, on Instagram, and you live kind of out loud, and you also try to optimize your health. It's very, very important to you. So I wondered if you could explain this to me that I see on a fairly regular basis and how this fits into a healthy lifestyle.
Every Friday, and everyone that knows me, every Friday, I treat myself to cupcakes. I have a voracious sugar tooth. I love cupcakes. Cake is fine, but I know there's just something about cupcakes. So two things here really quickly. One, this was a picture from this Friday. There's a couple off camera, so I did have more than 4. Yes, I do eat them all in one sitting. So I did have more than 4. And it's my only cheat of the week. Like, that's all. I eat very clean and healthy during the week, but every Friday, that's my treat. So, yes.
Excellent. Well, you do deserve it because I do see how hard you work out and how disciplined you are. I tell you, we got a last minute question. If you wouldn't mind, Jamie.
Of course.
Jamie Catherwood has asked, what are your thoughts on tokenized funds from large asset managers and the developments in the tokenized RWA space? And maybe start with RWA and what that means.
Well, I got to start with Jamie Catherwood is a genius. I love this young man. To see his come up on X back in the day, formerly Twitter, was phenomenal. So Jamie, good to see your face. Appreciate the question. RWA is what I was talking about before, real world assets, right? So this would be a real world asset according to the folks in crypto. Let's tokenize it. So the tokenized funds from the large asset managers like Bildel and Benji, I'm a fan of. I think that makes sense. There's a few things I have an issue with right now is that one, you obviously high net worth folks, everyone can't get access. Jamie, I think you'll find this interesting. I think Jay, you will as well. I think one of the things that I think this leads to, and I want it to lead to, and I'm going to start steering the space that way, is if we are able to have tokenized funds or tokenized money market funds, now we can have this available for financial advisors to basically say, all right, we can have an on-chain, right? And again, for those keeping score at home, when you're saying tokenized, that's a cute way of saying on-chain. They just don't want you to say on-chain. It's okay. You can have an on-chain fund or money market fund, your favorite Fidelity or Vanguard cash management fund for your clients. That'll make it easy for you to move in and out of all types of assets in real time, which I'm excited about. So I'm not over the moon about seeing this currently. I think it's a great step forward, but I think it'll be really exciting for me once Fidelity, Schwab, Altruist, Pershing, LPL, Raymond James have a on-chain money market fund for advisors. Then I think we're really talking. Great question, though, Jamie. Great to see you, man.
Jamie, Patrick, Jeffrey, appreciate the questions today. Tyrone, thanks for coming on. Educational as always. Will you come back on in the future?
Of course I will, so long as you will have me.
Thank you, sir.
The listener of this content should not assume that any information presented or made available on or through this media channel is receipt of or substitute for personalized investment advice. Titleist Asset Management, LLC, or TAM, is an SEC-registered investment advisor. Registration with the SEC does not imply a certain level of skill or expertise. TAM provides its services to individuals, high net worth investors, including trusts and other legal entities, and provides access to model portfolio strategies offered through its affiliate, Shorebird Capital LP. For a copy of TAM's disclosure documents, please visit www.advisorinfo.sec.gov and follow the search instructions.